Hey, good morning, everyone. It's Matt Donaghue with your weekly market update from Mission Financial Planners. Before I dive into the details of this week's market performance and some of the trends we like to talk about, I just want to invite everyone to our upcoming webinar on March 12th. That's going to be at noon Central Time. We're going to provide an in-depth analysis of the Secure Act 2.0 and its impact on retirement and especially tax planning. So you're going to want to make sure you go to our website, missionfinancialplanners.com, click on the events tab, and you'll be able to get signed up for that. So make sure you sign up. Analyzing the economic landscape, some consumer spending, inflation, and market trends. Well, the markets and the broader economy are shifting right now. Consumer spending, inflation trends, and employment numbers are playing significant roles in that shift. Over the past week, real consumer spending declined by 0.5% month over month. That's a slowdown, or an indicator, I should say, of a slowdown in economic activity. And that suggests that people might be pulling back on discretionary spending due to maybe inflation or potentially uncertainty about the future as far as the economy goes. So we'll see how that plays out. At the same time, headline personal consumption expenditures, PCE, inflation increased by 0.3% month over month and 2.5% year over year. That was roughly in line with what was expected. Inflation is still above the Fed's 2% target, but the recent data suggests that pressures are moderating compared to the highs of some of the previous years. Looking ahead this week, we're going to see two economic indicators get reported. One is the Purchasing Managers Index and the non-farm payrolls. That Purchasing Managers Index gives you insight into manufacturing and the service sector performance, and it's a leading indicator of economic activity. So we'll see what that looks like. Non-farm payrolls, that gives economists clues about the health of the labor market, which is a critical factor in sustaining consumer confidence and spending. We've had a lot of questions about what's going on at the federal government, how is that going to affect the economy, things like that. So just a little bit, some ideas for you on the Department of Government Efficiency. I'm going to say it wrong. DOGE, I think, is how you're supposed to say it, but cutting costs and its implications. So this could impact the broader economy, right? Because DOGE is tasked with reducing government expenditures and improving governmental operational efficiency. And one of their first initiatives has been workforce reductions. They've had approximately 75,000 federal employees, I should say, accept buyout offers, and thousands of probationary employees have been laid off as well. Now, those measures are expected to yield some cost savings, and they may have an impact on the budget, but it'll most likely be limited. All those personnel reductions represent about 6% of total U.S. government expenditures. So that's not insignificant. It's just not a huge driving factor in getting federal expenditures down. Beyond workforce reductions, DOGE is exploring other cost-cutting measures, including pausing federal grant payments to state and local governments. Now, those totaled almost $1 trillion in fiscal year 24, and that's 14% of federal spending. Now, given the reliance of state and local governments on those funds, which account for approximately 24% of state and local government receipts, those cuts could create financial challenges at the state and local level. So while and anyone who knows me knows that financial discipline has been something I have been cheering for years, and nobody has ever been listening. But while that financial discipline at the federal level is necessary for long-term economic sustainability and stability, well, the unintended consequences of spending cuts do have to be taken into account. So consumer confidence has already been declining at its fastest pace since 21, so right on the heels of COVID, and that's driven by concerns over layoffs, reduced federal support, and uncertainty around trade policies. If confidence remains weak, consumers may further reduce spending, and state and local governments might struggle to maintain hiring levels, which will then slow job growth as well. Striking the right balance between fiscal responsibility and economic stability, that's really the key in the months ahead. So we'll see how that plays out. Philosophy and financial decisions. Okay, oh my God, the sky is falling is what some people are always seems to be thinking. But you know what? It's like anything, right? You have to be a unified human being, good or bad. The world around you is the world around you, right? Some days it's good, some days it's bad, but it's the world around you. You, though, always need to be working on your own reasoning or on the things out of your control. So what would you rather focus on? The things that you can control, which are the way you view the world, how you react to the things that go on in the world around you, or the things that you can't control that are going on around you. Okay, so take care of yourself, take care of what's on the inside, and don't worry so much about what's on the outside. And that is, to quote Epictetus from 2,300 years ago, stand with the philosopher or stand with the mob. It's up to you. So, in an increasingly complex and unpredictable financial world, don't let yourself get pulled in multiple directions. We all face competing desires, fears, external pressures, and all that stuff can cloud your judgment. So that idea from Epictetus reminds us that internal consistency and disciplined reasoning are really crucial, especially when you're making financial decisions. So whether you're managing investments, you're planning for retirement, making everyday financial choices, stay grounded in long-term principles. Don't react to the short-term noise. Tax tips, the power of non-cash charitable contributions, some key insights on those. The average household donates a lot more than what they think they do, so make sure you keep receipts. Get a written receipt. Use IRS Form 8283 if non-cash donations exceed $500. Photograph donated items and refer to the Salvation Army's valuation guide for fair market value. You can see more in our written blog post. Our webinar coming up on March 12th is the Secure Act 2.0. We're going to talk about how RMDs changed, elimination of RMDs for Roth 401k and 403b plans, higher catch-up contributions. We're going to talk about how this affects employers as well, such as automatic enrollment in 401ks, Roth employer contributions, and expanded access for part-time workers. So March 12th, that's a noon Central Time webinar. We're looking forward to seeing you. Thanks again, everyone. Have a great week, and we will talk to you soon. Bye-bye.